Hello there. I hope that you're doing well. Welcome to the second episode of the Swing Trading series. During this episode, I will be discussing intra-week trading. This style of trading is, in my opinion, likely going to be the most sought after swing trading approach for the majority of viewers of the series. The reason why is because this style of trading is a balance between intraday trading and longer term trading. This style of trading is ideal for the person that is working a full-time job and doesn't want to spend much time behind the charts but still wants to make his or her analysis and take trades based upon that. With that being said, let us begin this episode. Intra-week trading. First of all, for the higher time frame analysis, when it comes to this style of trading, we will be paying attention to the weekly and daily charts. The times of interest for this style of trading will be specific days and specific sessions. This is something which I will discuss later during the series more in depth. The execution timeframes for this style of trading will be H4 or hourly charts. Personally, I prefer hourly charts, and that's a result of me preferring more candles when I'm looking at the charts than less candles. However, if you would like to use less candles within your analysis, then you would use the H4 chart to execute upon. The higher time frame analysis. In order to establish your higher time frame analysis, you must first understand everything which we need to look at in order to come to the conclusion what the underlying draw and liquidity is and what the underlying narrative is. Therefore, I highly suggest you to go back through the model series, and as outlined during episode 1, this series is not meant to be first watched when you come to my mentorship. I highly suggest you to first go through that model series before you go through this series, because I'm speaking to someone who already has a certain understanding of the way I approach the markets. However, when it comes to the higher time frame analysis, what's very important is that we first of all base this on weekly and the daily charts. Meaning, based upon the weekly and daily charts, we establish, alright, what are the markets likely going to do next? What are they drawn towards? What is our draw and liquidity? We determine key liquidity pools, meaning we determine key time-based liquidity pools. Think about, for example, yearly highs and lows, monthly highs and lows, weekly highs and lows. And next to that, what we do is we pay attention to the weekly and daily arrays that formed. Think about weekly or daily imbalances, or weekly or daily breakers, or mitigation blocks and such. When you begin aligning key liquidity pools with weekly and daily arrays, what you will begin to notice is that liquidity gets engineered in advance of these weekly and daily arrays. And therefore, you know that that liquidity pool which you're targeting is a very strong draw on liquidity when the underlying order flow is signaling to you that that is the draw. Times of interest. When it comes to the times of interest of intra-week trading, we mainly pay attention to specific days of week utilizing the economic calendar. We pay attention to the days with high impact news. Those are the days we focus on. The reason why is because on these days we know that volatility will get ejected, and we also know when it will get injected. The session of day is usually the London or the New York morning session that we look to focus on. Meaning we don't look to trade Asia. Meaning we don't look to trade the New York PM session. We purely focus on positioning ourselves inside the markets during either the London or the New York morning session on these specific days that we have interest in. We don't care about anything else. And this is how we use the times of interest. Notice that I'm not dropping down into smaller time cycles such as 90 or 30 or 10-minute cycles. No, all we need to know is where's price at for the current session. And when we have that established and it's aligned with our underlying narrative, we can anticipate that the time is now right for the next delivery profile to take place. Let us pay attention to some examples, and this will all be clarified for you. I'm a big believer in the fact that when you get introduced to theory and when you get introduced to bullet points like I just described to you, that you need to see them visually applied and that you need to watch over my shoulder whilst I'm applying the logic which I just described to you. Because if you would investigate what I just described to you next to everything when it comes to, all right, this is how we establish our narrative, this is how we establish our draw liquidity, this is how we establish a point of interest, all these things have been taught within the model series. If everything within the model series is clear to you, and instead of dropping down into the lower time frames, you would just stick to the RE chart, man, oh man, you're in for a treat, because you are going to see that intra-week trading might actually be something worth considering. Now, here we're on the weekly chart of Nasdaq, and what I will do is I will walk you through some examples on Nasdaq and GU of basically intra-week trading opportunities presenting itself. What I want you to see is that throughout 2021, Nasdaq was repriced towards the upside. Notice that every single expansion was followed by a retracement, followed by a new expansion, followed by another retracement, followed by a new expansion, followed by a new retracement, followed by a new expansion. This right here is of course a characteristic of bullish order flow. Higher highs, higher lows being made when we speak in layman's terms. However, what I want you to see is that throughout November, Nasdaq was unable to continue this underlying bullish order flow. We saw the market begin to consolidate. When 2022 then opened up, what we saw occur was that Nasdaq displaced towards the downside. Notice that this sequence of imbalances formed. You have the first imbalance which formed up here, the bearish value gap, and the second bearish value gap formed here. But why is this sequence of imbalances so important? It's so important because this sequence of imbalances formed whilst Nasdaq was repriced below this low. This low was so important because this low set up the final run higher. Notice that this low was utilized to reprice above this high, above the buy side liquidity resting above this high. Notice that throughout this leg higher, multiple imbalances formed. And as you have learned within the model series, you know that when these imbalances get overrun, and preferably new imbalances get created on the opposing side of the curve, that's a very strong characteristic of the underlying order flow changing from, in this case, buy program to sell program. Notice that I've annotated this weekly CB right here. The reason why I've only annotated this weekly CB is because it formed inside of this down close candle, which is your bearish breaker, of course. When we pay attention to the daily chart then, what I want you to see is that I've annotated the January high and the January low, and next to that I've annotated the February open. What you will learn throughout this episode is that we can utilize opening times in order to fine-tune our entries. When it comes to positioning ourselves short inside of a market that we anticipate to draw lower, meaning in a bearish market, we ideally look to position ourselves short above either the monthly or weekly open. What you can see is that when February opened up, we repriced higher into the higher end of that weekly CB, formed the high of the month there, and then Nasdaq began expanding towards the downside in this initial run lower right here. Do you see that? You see that we form this high and then this first drop lower takes place. Notice, however, that this drop lower was not sustained, meaning the market came back above the February open one more time. So what does that provide you with? It provides you with opportunities to open swing positions on the downside, meaning short positions. When on specific days of the week that the economic calendar is suggesting to us that we should anticipate certain price movements to occur. Notice when the market trades above the February open, it isn't taking long before it rejects it. We spend just a few days above it and then the market displaces lower and it begins the sell program. What is the market drawn towards? It's drawn towards this sell-side liquidity pool of the January low. Notice that a new CB forms right here. Retracement into that CB and into that weekly CB takes place again. This is again a shorting opportunity on the lower time frame. And what I want you to see is that I'm consistently looking for market maker sell models because I established that the underlying order flow changed when we displaced below this low. This low is that weekly charts its respective low. And because we repriced below that low and we saw those imbalances form throughout that leg towards the downside, it tells you, all right, we're likely going to see sell-side delivery taking place next. When we then pay attention to the hourly chart, what I want you to see is that when we opened up for the month of February, we initially saw the market consolidate around that open, and we then saw the market expand towards the upside. Notice that it traded above that weekly CB's price range right here. Wednesday opens up, and what is so important about Wednesday? What's so important about Wednesday is that we open up by this vertical line right here, and we initially run towards the upside. Why is that run towards the upside important? You might be wondering. Because just like I described to you the importance of the monthly and weekly open, we can also utilize the daily open to even fine-tune our entries even more. What you can see is that the market expands higher initially, retraces, and then has one more push towards the upside. When does this push towards the upside take place? During the New York morning session, during the AM session. And when you pay attention to what took place throughout the morning session, you will see that at 8:15 a.m. there was high impact news. Next to that, there were OPEC meetings all day, but it is the high impact news at 8:15 a.m. which is so important because that is a volatility injection which we can use to basically monitor, all right, are we going to form a weekly high in this area? Notice that when that news release took place in this down close candle right here, we saw the market expand lower. Notice that the next candle opens high back into this low and then immediately expands away. It draws towards the downside. Notice that we are now drawn towards sell side liquidity next. Why? Because a change in the state of delivery occurred the moment that price displaced below this low. Don't look at the trading above this weekly CB's range of this blue shaded box as, oh, now Nasdaq is bullish, now we're going to run higher. Why not? Because this is manipulation which is occurring on that day where we have high impact news inside of a week of NFP. We look to position ourselves before the end of Wednesday's morning session. And then we let everyone gamble throughout the remainder of the week in advance of NFP. Our focus is on the end of Wednesday's morning session. If we are able to find a swing opportunity in advance of the end of Wednesday's morning session, we can leave that position running all throughout the week. And what you can see is that when the market expands lower like this, what is it drawn towards first of all? And what would be the first logical partial objective? Well, I want you to pay attention to this low right here. This low was the low of that consolidation which occurred around that February open. But when you pay attention to time, you will see that this was your previous day low. When you pay attention to the range between the potential entry in this area and the potential take profit right here, you will see that this is a massive range on the downside. And this is exactly what we're looking for. Because let's say that your stop loss is placed above the swing high. It's the easiest way of defining your stop loss. Don't worry, I will explain more in depth on how to actually utilize entry patterns when it comes to intra-week trading. But for now, I'm just explaining the overall frameworks to you. And notice that patterns for entering are details. At the end of the day, the entry is the least important. What is important is that you understand the underlying narrative behind why something should occur. Why should Nasdaq draw lower now? Why should it begin to reprice lower? Why should it begin to roll over? Because when that is clear, any retracement higher can be looked at as a potential shorting opportunity. So what I want you to see is that the range between the potential entry in this area and the objective is of course pretty huge. And when you start intra-week trading, your focus shouldn't be on capturing 4, 5, 6, maybe even more trades. No. Just focus on 1 or 2 good moves and be done. Don't look to do more than that. The reason why I mentioned that you shouldn't try to do more than 1 or 2 opportunities is because every single week there are about 1 or 2 opportunities that are so clean that you can anticipate coming in advance based upon the economic calendar and how the market is delivering towards that specific day that you have interest in, where you can say, all right, this is likely going to happen next. And those are the type of moves that an intra-week trader is interested in. Notice as well that on the lower time frames, this is where your market maker sell models would present themselves on the 1-minute chart. Now, when we pay attention to that opportunity which presented itself later throughout the month of February inside that weekly CB, you can see that I have plotted the economic calendar again right here for Thursday. And what I want you to see is that throughout the morning session, the CPR release took place at 8:30 a.m. Now, when we pay attention to this weekly delivery profile, what you can see is that when the market began delivering for the week and we saw the market open up, we initially saw a drop lower right here on Monday and Tuesday. Then throughout the middle part of Tuesday, however, a low formed and the market began expanding towards the upside. Notice that throughout Wednesday, this expansion continued, but throughout the latter part of Wednesday, a high formed and the market began consolidating, began going sideways. Where is it going sideways? It's going sideways in a premium of that weekly CB. And when you pay attention to price, you can see that's going sideways around that 17,000 big figure. If you are aware of the advanced price ranges, you will understand that this is a very important price level to monitor. Now notice as well that price is consolidating inside of this large CB from that initial expansion which we monitored. Therefore, what we're interested in seeing is, all right, how are they going to run with the CPR release? What are they going to do with that? What I want you to see is that in advance of the morning session on Thursday, nothing really happened. The market just consolidated. However, when that CPR release took place inside this downclose candle, you can see that we initially repriced higher and then had this sudden drop towards the downside. A retracement occurs, but notice that the market didn't retrace all the way back into this candle's low. Therefore, a RECB is being created. The market retraces into that CB, and this right here, yes, is where an intra-week swing trader would look to position themselves short. And the reason why is because they understand that, first of all, price is trading above the February open. The higher time frame order flow has changed, meaning we're anticipating lower prices for the remainder of the month to come. And next to that, what you can see is that relative to the economic calendar, IPTA is tipping its hand to you, meaning it's tipping its hand through the creation of this CB on the RE chart on the day of CPI. And when you pay attention to these lows right here, notice how smooth these lows are. Notice that these lows are below that weekly CB of that blue shaded box. Therefore, a intra-week swing trader would look to short inside of the retracement into this red box, and they would place their stop losses above the high of this candle right here, because this is the highest high inside of these three candles which set up the creation of the CB, as you can see. Candle 1, candle 2, candle 3. Therefore, this high should remain intact. And that right there is one of those key algorithmic signatures which you need to understand. And notice that I'm not even discussing intermarket relationship with you just yet. Notice that I'm not even discussing the fine details within this price action with you just yet. All I'm doing is I'm explaining to you, all right, this is the framework which you can utilize to already begin thinking like someone who is looking to capture the majority of the weaker range. Because what you need to understand is that what this style of trading basically allows for is to stick to the RE chart and execute based upon that without having to worry about 1 minute market maker model fractals. So it's basically stopping where an intraday trader would go into the 1 minute chart. And someone who's interested in participating in the full week range would allow for a bit more room when it comes to his or her stop loss and of course the invalidation. But next to that, what they're also doing is they're targeting a bigger objective. And that objective will get reached during more time. And that's the true difference between intraday trading and intra-week trading. And that is something which I want you to think about as well moving forward. What style of trading suits you best? When we pay attention to a bullish example, then what we will do is we will pay attention to the weekly chart of GU. What you can see on this weekly chart of GU is that GU expanded towards the upside throughout 2023, and it then formed this high right here. A sudden drop lower took place, and notice that a new low formed in this area. Notice that after this low formed, every single down close candle began functioning as support or price. This is a sign of bullish order flow. Notice that the premium range which formed on the left side of the curve right here failed to function as resistance on price. Therefore, what we're anticipating is that we're likely going to see a new leg higher taking place. What I want you to see is that the market consolidated in this area and just went back and forth for a while. 2024 opened up and we initially saw the market drop lower. A run higher occurred, and what you can see is that the market took out buy-side liquidity, and what you can see is that a new high formed and the market dropped lower. In what did it drop lower? It dropped lower into this old down close candle. Notice how the bodies are respecting that down close candle right there. Notice that this down close candle formed in the lowest CB right here. Notice as well that the down close candle formed inside of this bearish breaker. This bearish breaker is an inverted bearish breaker because price displaced above it. Therefore, we anticipate that it's likely going to function as support on price. And that's something which I've, of course, discussed more in depth throughout the 2024 mentorship. But I will discuss inverted breakers more as well throughout this series, probably when I'm explaining to you, all right, what are we looking for when it comes to confirmations of order flow changing? Because when you begin to understand inverted breakers and inverted mitigation blocks, a whole new world will open up to you, because all of a sudden it will become clear to you when IPDA is allowed to expand towards a specific high, when that high isn't necessarily a clean consolidation. Because in this case, this is not an original consolidation as you know it. It's not like, oh, you see a clear consolidation and you know, yep, that is where buy-side liquidity is resting. No, it's just two candles higher and then followed by this sudden drop lower. But you still need to understand that this is where buy-side liquidity is resting. This is where retail-minded traders are seeing resistance right here. When you pay attention to this high right here, it's exactly the same fractal, where you see one big up close candle. That is your buy-side liquidity engineered, and that is all we're looking at. When you pay attention to this high, it's exactly the same. When you pay attention to this high, it's exactly the same. When you pay attention to this high, it's exactly the same. But this is where those key buy-side liquidity pools that are time-based come in play. And that is why you need to hover over swing highs to see, all right, what is the time when this swing high formed? Because this high, guys, was the 2023 high. So throughout 2024, what high are we referring to? We're referring to the previous yearly high and low, of course. And when you pay attention to how the market reacted off this down close candle, look at how the bodies were respecting that, it shows to you that the underlying order flow is likely going to begin being bullish soon. Displacement higher occurs, and this weekly imbalance forms, this BC. But notice that whilst this weekly BC is forming, the market is also trading above this low. Why is this low important? Because we see a high, low, higher high, lower low. Therefore, the final down close candle inside of this low formation before this push higher took place is a bearish breaker. Price displaced above that with this BC, so this is now an inverted bearish breaker, which we can utilize as support on price to anticipate repricing higher to occur. And this is again how you can see the importance of keeping certain arrays on your chart. Notice that the market expanded higher and it took out the buy side liquidity resting above this high. Notice that a new retracement unfolded and the market traded back into this weekly BC. Notice that the market found support inside that BC and it then expanded above the 2023 high, which was right here, of course. Notice that when this high was taken out a BC formed throughout the run towards the upside. Actually, two imbalances formed, but I'm annotating the highest one. And the reason why I'm annotating purely the highest one is because this highest one has to function as support and price in order for the next displacement leg higher to occur. That right there has to do with the price on the right here that this BC displays through, and the fact that when we are looking at continuation to take place, we're looking at the second imbalance that formed to function as support and price in order for the underlying order flow to remain very bullish. If GU would have retraced deeply, then it wouldn't have been a sign that we would have been a fan of for that continuation idea. But what I want you to see is that a new high forms right here. The market retraces. It retraces into this weekly BC right here. Notice that when this weekly BC was reached, a low formed and the next leg towards the upside took place. On the lower time frames, this is a market maker buy model fractal. And that right there is looking inside of fractals, and that is a skill which you need to develop. When we pay attention to the daily chart then, what I want you to see is that I've annotated the September open right here. And as outlined prior, but in first now, because we first looked at bearish examples on the Nasdaq, we're now looking at a bullish example on GU. So what we will do is we will say, all right, well, in a bullish market where we're anticipating higher prices, we are looking for the following to take place. We're looking for the market to drop below the key open. And when it drops below the key open and it shows to us that the time is right for continuation higher to take place, that is where we try to position ourselves long for that continuation idea to play out. Because what is resting above this high? Newly engineered buy side liquidity, guys. When we pay attention to the hourly chart then, what I want to see is that on the hourly chart, you can see that the market delivered towards the downside. We can see that there was a lot of back and forth going inside of the higher end of that weekly BC right here. On the Wednesday, on the 11th of September, what you can see is that the CPR release took place. Notice that the CPR release took place right here in the beginning of this sequence of down close candles. And the reason why I'm mentioning this in particular is because inside of this sequence of down close candles, retail-minded traders are being taken out when it came to their long positions that were on earlier. Sell-side liquidity was engineered below these lows. But next to that, these down close candles are also trapping retail-minded traders into believing that GU is likely going to continue dropping. They look at that and they think to themselves, all right, it's time to go market short on GU now because it's very weak. It's time to basically go to zero, right? It's time to keep on dumping. But that's exactly what we are looking for, because that right there is manipulation. And what flows after manipulation? Always distribution, guys. Notice that I've annotated the lowest CB right here. And the reason why I've annotated the lowest CB, the final CB which formed, is because what you can see is that this CB was utilized as an inversion to value gap on price the next day on Thursday. Notice that throughout the London session, the market formed the low of day, where below the midnight opening price. And that throughout the morning session, the market let this low intact. Notice how it found support inside of this wick right here. Now you might be wondering, where can I look to enter? How can I look to position myself long? Well, in this case, what you can look for is you can look for this CB to be utilized as an inversion for value gap. Meaning you can look to go long inside of this CB the moment that IPTA is showcasing to you, all right, we're displacing higher. It's a buy program which is going to unfold soon. You might be wondering, how do I know that the time is right for that buy program to unfold? The answer to that question, guys, lies in this annotated sell-side liquidity pool. The moment the price displaces above this low and this CB right here, it's IPTA tipping its hand to you and it's basically telling to you, yep, I'm going to deliver higher now. And that right there is one of those things that once you see it, you can never unsee it, because it occurs across all time frames, across all markets, across all asset classes. Doesn't matter what time frame you're looking at. This is one of those applications of time cycles that's absolutely going to blow your mind when you begin investigating. And next to that, you might be thinking to yourself, how do we know that this is the low of week? How do we know that this is likely going to be the absolute low before the market begins expanding higher? Well, first of all, you need to understand that I've just described to you based upon the weekly chart why the underlying order flow was still bullish for GU. But next to that, you can see that the news of the CPI release was utilized to manipulate lower trading into that weekly BC. Guys, when you see an important news release like CPI get utilized like this, it's the perfect manipulation before distribution can occur. Note that the market reprices above that weekly BC, and whilst it leaves that weekly BC, this RBC forms. Notice that this is occurring below the September open. Market retraces into that RBC, and that was again an entry opportunity, but then for the next week, because on Friday we do not want to position ourselves in any new opportunities when it comes to intra-week trading for the current week. I'm not saying that's not possible to enter on Friday. However, you would have to hold through the weekend, and within the current environment, that is not ideal in my opinion, because the volatility is just through the roof and the tensions are through the roof as well. And that's a result of the fact that there's a lot of chaos in the world, and therefore it only takes one crazy event to take place throughout the weekend, and what you thought to be a nice entry on Friday appears to be an absolutely chaotic entry the moment that on Sunday the markets open up, and that is not worth the risk in my opinion. However, let's say that you would look to enter in this area. This was again an entry opportunity inside of this RBC. Note that we have RE imbalances on the left right here as well, which could have been utilized. Now, the final example which we're going to take a look at is a sell program on GU. And this sell program unfolded throughout Q4 of 2024. What I want you to see is that I've annotated this high right here, which was the 2023 high, and I've annotated the low which formed inside of that weekly BC that we just looked at as a potential long opportunity to expand towards the upside. Now, what is so interesting about this delivery is the fact that we were looking for longs inside of this area, inside of this market maker buy model fractal. Now, the final example which we're going to take a look at is a sell program which unfolded on GU. What you can see is that I've annotated again this buy side liquidity pool right here of that 2023 high. Notice that we just looked at this fractal to frame a buying opportunity right here intra-week. But notice that I've now annotated this low with the light bulb meaning the market structure shift. What I want you to see is that when the market expanded higher throughout this delivery right here, eventually a swing high formed. The time was right for GU to be repriced towards the downside significantly throughout the fourth quarter of 2024. When the market displaced below this low right here, and it functioned as resistance on price right here, it showed to us that the underlying order flow was now bearish on GU. The reason why was due to the fact that this low formed inside of this BC first of all, and next to that, this low set up the final run higher before this swing high formation took place, and next to that, this low formed around that 1.30 price level, and that's an important price level for GU. Now, we saw the market displace towards the downside afterwards, and we saw this weekly CB form. Notice I've not annotated this weekly CB because that is not what I want you to focus on within this breakdown. However, you should be able to see that this is a bearish fair value gap which formed right here. Notice that the market retraced into that bearish fair value gap and expanded lower once more. Notice, however, that it stopped right in advance right here of this low. What is that? That right there is the engineering of sell-side liquidity which has taken place. And notice that this low was the low which formed inside of this down close candle right here. And the reason why this is so important to note is due to the fact that when you begin to understand the engineering of liquidity, you'll be able to look at these markets from a completely different perspective, and all ambiguity will get lost, because all of a sudden you'll be able to explain exactly why the market did what it did, but more importantly, when it did what it did, when the time was right. Now, what we will focus on is the delivery inside of this repricing lower which occurred. Now, on the daily chart, what we are monitoring is the following. What we are monitoring is the reaction to this upclose candle. This upclose candle in particular is so important because in bearish order flow, we're looking for every single opcos candle to function as resistance on price. But next to that, this opcos candle was the final opcos candle before the market made this sudden drop lower. Therefore, we need to see it function as resistance on price in order for the order flow to remain bearish. If we would have seen GU this way, above this opcos candle, utilized as support on price, then a completely different game plan was in play. However, because we saw the signs of a swing formation taking place inside that opcos candle, it signaled to us that we were likely going to see the next leg lower occurring. Because this right here, guys, when you have a higher time frame key level like this, a higher time frame sell at Liquidity Pool objective, an old monthly low of months ago, and you see the market stop right in advance of that throughout the previous week. You have a previous week's low and a monthly low so close to each other. It's like, what else do you want, right? When we pay attention to the RE chart then, what I need you to see is the following. What I need you to see is that when we opened up this week, we initially saw the market begin to run towards the upside. It was in a rush to be repriced higher. Notice that multiple imbalances formed, but my eye is drawn towards this imbalance in particular. The reason why this imbalance in particular is so important is because this imbalance formed whilst the market was repriced into that opcos candle of the daily chart, its range, that red box. Notice that the market retraced into that BC. We then saw time distortion taking place. Market was just consolidating, was going back and forth in this area. A new expansion leg higher occurs and the market takes out the Monday high. But when? On Tuesday. Open high on Tuesday. We open, run higher, trap people into believing higher prices are next, take out buys at liquidity resting above these highs, form a swing high throughout the long session on Tuesday, and we begin to see the market displace lower. Notice that this CB gets formed right here, the CB which the New York morning session retraced into, and then the market began expanding towards the downside. It was in a rush to begin running lower. This CB by itself was already a potential shorting opportunity due to the fact that intermarket relationship was telling to us that this would likely be the weekly high inside of the underlying bearish order flow on the higher time frames. Notice that the market displaced lower and a new CB formed right here. Notice that the CB formed inside the price range of this large BC on the left side of the curve. What I want you to see is that when we pay attention to this blue shaded box, the reaction to this blue shaded box will tell us whether or not the market is going to draw towards this red line, that old weekly low. Notice that the market consolidated near the lower end of that REBC. And then when Wednesday opened up, we saw the market open high, form the daily high, and then throughout the London session begin expanding towards the downside. The market was in a rush to be repriced lower. What was it drawn towards? Towards the previous week's low, which formed right here. Notice that when this low was taken out, the market began consolidating, began going back and forth for a while, and we saw the market retrace into this CB eventually with this wick. Notice that when the CB was reached, the market immediately rejected that and it repriced towards the downside on the next day. Now you might be wondering, where are the opportunities to go short? Well, the opportunities to go short based upon everything which you have learned throughout this lecture are up here inside of this CB, and next to that inside of the price range of this BC, which is being utilized as an inversion for fire gap. I will teach you later during this series how to actually use specific entry patterns, but at the end of the day, the entry pattern is the least of your concern. What matters is that you're able to frame the underlying logic behind why something should occur, and more importantly, when. With that being said, the second episode comes to an end. I hope that you found it insightful and I hope that you were able to learn something from it. If you did, please let me know. During the next episode, I will walk you through how to actually swing trade for days, weeks, or maybe even months in a row. And that is a style of trading which requires a lot of patience, and it's probably not suitable for the majority of you watching. However, some of you have really requested me to make a lecture on this topic, and that is also where the inspiration for the swing trading series comes from, because swing trading can be applied to all time frames, meaning you can be looking at intra-week trading, you can be looking at, for example, just your regular quarterly trading, or you can look at, for example, holding on to positions for years and really build big investment portfolios and such, utilizing the theories as I'm explaining them to you and you giving them your own touch and such. At the end of the day, you need to pick what you are most comfortable with and what suits your approach to markets. So I want to wish you good luck within your studies. I look forward to catching up with you in the next one. Be safe.